Hello and welcome to the Weekend Investing Daily Bite of 13th of December. A wild day today. Markets first collapsing in the morning, breaking important supports, and then swinging back very hard, almost 600 points from the bottom to end in the green. A lot of traders would have got hurt today. This kind of a slingshot move, as it is called, is not common. And once it does happen on any day, I mean, there's a lot of bloodletting by short-term traders there. Alarming signals from contrasting SIP data. That is our topic for discussion in the second half of the video. Do read the disclaimer and subscribe to the channel if you haven't so far, and click on the bell notification. So you can see here on the chart, markets dropping below this very important 24,500-ish level in the morning, went down, broke the recent bottom, and then very sharply came back up. So almost you can see 24,180 to 24,792, 600 points on the trot from the bottom, catching most traders on the wrong foot in the morning and then recovering back at the end of the week. So overall, the weekly candle is looking good. 0.89% posted on the Nifty. These kind of moves are signals of who is having the upper hand. So while the bears attempted to break the market this morning, the bulls came back up very strongly after the first 2 hours and ambushed the bears, so as to say. So now we are set up with a lot of potentially short positions which are stuck uh, unless most of them have covered today, and that may fuel a upward rally in the coming week. That is now the likely outcome that is going to happen. You can see how beautifully on the Nifty Junior also the support was taken at the previous high. So these are some of the, technically, of course, it will not happen every time, but very high probability support points can sometimes really make a lot of difference to short-term traders. Minus 0.6% on the Nifty Junior. Again, on the Nifty mid caps also, you can see the mid caps taking support at the previous highs, 0.1% negative for the day. Overall, I mean, no real harm done on this. And for small caps, down 0.36%. If we now move above today's high and close this gap, we will probably again take a shot at this previous all-time high. Bank Nifty also coming down, breaking the support and then moving back up very rapidly, 0.69% on Bank Nifty. So there is this underlying inherent strength from wherever it is coming. It is showcasing that the market as of now doesn't want to go down. And now today's low becomes the new pivotal point going forward for the immediate short term. Momentum trends, however, were not in favor of the advances. This is now, telling you that the broader market was not so much in sync with what Nifty was doing. So 200 advances to nearly 300 declines. So gradual decline was happening in the rest of the market, whereas in the top of the market, you had HDFC Bank, ICICI Bank, State Bank of India, Reliance, HCL Tech, Bharti Airtel, big gains in Bharti Airtel, Ultra Semco, Titan, Hindustan Levers, and ITC up for a change. All these stocks running up. Most of the stocks actually were in the green, and you will see a very contrast on the Nifty Next 50 heat map where most of it is red, and you had very sporadic, green spots on this. Big losses in Chola Finance, IRFC, ATGL, TV's Lab, and so on. In the sectoral trends, so you had FMCG come back a little bit, 1.3% on FMCG. Infra stocks up 1.2%, consumption stocks 1.2%. Private banks also up 0.8%. So mixed bag, but skewed towards the uh, the greens. Only metals losing big in terms of 0.7%, and real estate maybe some profit booking there at minus 0.4% and 0.3 and 0.2% on pharma and PSU banks. So overall, no harm done. I think market is still very much intact and looking to go upwards. ITC was the biggest gainer in FMCG. FMCG stocks have now sort of completed the year with zero gains. So from last December to now, FMCG index is where it was. So sometimes you will have to bear with the consolidation in certain sectors. Maybe it will continue for some more time. I don't know. ITC and levers leading the rally at nearly 2% each. Nestle and Dabur at 1.2, 1.3%, and you had United Breweries and Colgate also following suit. In the stock spotlight, you had KPR Mills go up 6%. KPR Mills has gone up quite dramatically since 2020. It was at 60 rupees, and now we are trading at 1,000 rupees, gradually going up and looking good. This kind of a new high that is getting made in a weakish market or for flattish market is a good sign. Topic for the day is alarming signals from contrasting SIP data. So what do we mean by that? So there is something called the SIP stoppage ratio. What is the stoppage ratio? Is that if 100 new SIPs are getting registered, 80 are getting discontinued. So 80 of the historical SIPs are getting discontinued and 100 new ones are starting. So 39 lakh discontinuations happened in November. In October, it was 38.8 lakh. So that many SIPs getting stopped, although the new SIPs starting is tad more, possibly 25% more. Uh, so this ratio has been going up from 40-50% to almost 88%, to almost 80% now. It was highest in April, May at 88%. Then it came down towards 55, 60, and now it is up again. So you can see here that this this was the highest in COVID times, and then as the market really did well, people stopped stopping SIPs, if you know what I mean. And then once the market achieved October 21, beyond which the market became flattish, if you remember, for a year and a half, stopping of SIPs became higher and higher. And more recently, before the election, a lot of SIPs were stopped, fearing a lot of volatility. That was May 2024. And then post elections, it was reasonably stable. So 40, 50%, 55% is normal. There's no harm in that. But when you get towards nearing to 80, it does show you that people are very nervous. And while newer players are coming in, but there is a problem in this calculation. Now the stats I've already mentioned. The SIP stopping within 1 year are now 40%. Within 3 years is 70%. So 70% of the SIPs stop within 3 years, and you know very well that in the stock markets, unless you are invested for 5 years or more, or maybe sometimes even 7 years or more, there is a chance that you will not make any money. And that concept needs to be drilled into the new investors, that you cannot come to the market and expect that every 1 year or every 2 years you will make fantastic money. That cannot happen. So now the ratio has been going up for 4 months. The current ratio is near the COVID levels. This is the most alarming stat. This is from ET, that in the top, you can say, in the first 3 years of new SIPs, almost 85% of SIPs get of the mutual funds get sold. So this is very, very alarming. It means that most of the people are not making any money or any significant money. Definitely not market beating returns, because every 3 years, if this kind of churn is happening, of which 50% happens in the first year itself, uh, this is certainly not good news from a perspective of the user. While the market is getting the equivalent in newer SIP. So if we see, on the other hand, the contrasting data is that SIP inflows continue to go up from 18,000 to 20,000 to 24,000, and now even 25,300 at the end of October. So overall money coming in is going up, but how many of those people are actually making money is the conundrum. So this is what is happening. Lure of quick money. So many investors are seeking immediate high return. So they want that I come into the market and within 1 year I should be making money. And if I'm not making money, I'll exit. Right. So, and this exactly causes all kinds of selling also in the market, when a shorter term perspective investors go out. Then the other thing is that people are jumping ships. This entire thesis of which fund made the best returns last year, which small case made the best returns last year, and let's go to that. This is the biggest sort of mistake most people make, even if they stay in the market for long term. So jumping ships from one stock to the other, from one mutual fund to the other, from one small case to the other, is basically a discipline that is not there. And to try and seek short term gains from here or there is the biggest reason. Then a small correction in the market becomes a reason for a lot of people to go out, that oh, Trump is coming in, or something else is happening, or elections are coming, let's get out of the market. So this behavior that, I can time the market, I can come in and come out easily, is very, very detrimental to most investors. And the behavioral bias, more than anything else, even if your underlying instrument is creating value or performance, most of the participants of that vehicle will not make money, because you will almost always people most of the people will buy at highs and sell at lows. That is the, the complete sort of you can say summary of significant part of retail investors, that they will come to the market and not make money, not in their first stint at the market. Maybe they will come, they will go out, they will learn a lesson over a cycle, and then the next cycle they may perform better when they learn that, they need to stay in for long periods of time, they need not worry when market is going down, so on and so forth. Then the Magellan Fund is the exact real life example of this, when Peter Lynch, who all of you are well aware of, ran the Magellan Fund from 1977 to 1990, and he created annualized returns of 29% for those 13 years. But the average Magellan Fund investor lost money in that tenure. Now you can very well guess why this is happening, because while the fund was making money, it was not a linear curve. In one of the years, he was making 80%. In the next year, he was losing 40%. And people were timing, going in, coming out. So the average investor during that 13 years did not make money. I mean, how unfortunate is that, that you were able to come to that fund, which is the best performing fund of the world of all times. And even then, you are not able to make money because of you yourself. So your behavior, investor behavior, is the key reason why people will not make money in the markets. Don't do that. Don't try to time the market. You need to turn off the noise. Don't think that you know more than the market and you'll be able to beat it by going in, going out. Every fund manager will go through some cyclicality. If your fund manager is down for a year or two, don't write him off. Uh, Allow yourself to fully convince yourself on the strategy that is being used. If you are in line with that strategy, you know that, whenever the markets will go in your favor, your strategy will again do well. And avoid weakness and ride the strength. That is the momentum strategy that we want to sort of say that that is really the classic way of beating the herd mentality that is there in the markets. So do write in the comments, how have you continued your sips for more than 3 years? Do you know of your friends who have given up after 1, 2, or 3 years? Have you tried to convince them? And do spread the nice word about staying in the market and making money, because it is there for the making. Thank you so much. Please like and share these videos and subscribe to the channel. Thanks. Bye.